They stand as silent monuments to a dream, to a promise whispered in boardrooms and projected onto glass towers.
Empty. Abandoned.
Once bustling hubs of a supposed revolution in work, these sleek, modern spaces now echo with an unsettling quiet. This is the enduring legacy of WeWork, a company that ignited with audacious vision, only to see its flame consume an astonishing $47 billion.
A colossal sum.
This isn't just a story of business failure, it's a cinematic tragedy of ambition unbound, a stark reminder that even the most glittering projections can dissolve into thin air, leaving only ghosts behind. The stakes were immediate, the fall catastrophic. In the beginning, there was Adam Neumann, charismatic, visionary, a force of nature. He didn't just sell office space, he sold a philosophy, a lifestyle, a global community. WeWork wasn't merely a landlord, it was a movement, promising to elevate the world's consciousness through the power of shared experience. Early spaces thrummed with activity, a vibrant ecosystem of startups, freelancers, and dreamers. The narrative was intoxicating: forget stale cubicles, embrace collaboration, coffee, and a sense of belonging. This was more than real estate, it was an aspirational tech company, poised to redefine how and where we work, driven by an almost messianic zeal. The fundamental question that would ultimately unravel WeWork's narrative remained: was it a tech company, or was it merely a glorified landlord? Investors, blinded by Neumann's compelling vision and the intoxicating scent of disruption, poured billions into the enterprise. They saw software, network effects, and limitless scalability, not just desks and chairs. This critical misclassification allowed WeWork to command valuations far beyond traditional real estate companies, fueled by the insatiable appetite of venture capital for the next unicorn. The capital flowed, unchecked, into a model built on short-term leases and long-term commitments. A house of cards, built on a shaky foundation of perception. With billions secured, WeWork embarked on an aggressive, dizzying global expansion. Its iconic We logo began appearing in major cities worldwide, transforming properties into meticulously designed, amenity-rich co-working havens. From New York to London, Tokyo to Tel Aviv, the company acquired, built, and leased at a breathtaking pace. The strategy was growth at all costs, a land-grab mentality aimed at dominating the flexible office market before competitors could emerge. Thousands of employees were hired, millions of square feet leased. It was a race against time, a relentless pursuit of scale, where profitability often felt like an afterthought to market share. The sheer velocity was staggering. Adam Neumann was not just a CEO, he was the embodiment of the WeWork brand. His larger-than-life persona, spiritual rhetoric, and lavish lifestyle became intertwined with the company's identity. Private jets, grandiose parties, and a penchant for controversial pronouncements blurred the lines between personal and corporate. He trademarked the word "we" and sold it back to the company for millions. This behavior, often dismissed as eccentricities of a visionary, began to raise serious questions about corporate governance and fiduciary duty. The sheer audacity was initially overlooked, painted as part of the disruptor charm. But beneath the surface, cracks were forming. Despite its meteoric growth, WeWork was bleeding cash at an alarming rate. The company's financial model, relying on signing long-term leases and then subdividing them into shorter, flexible memberships, proved deeply capital-intensive. Billions were spent on renovations, technology infrastructure, and marketing, far outpacing the revenue generated. The promise was that scale would eventually lead to profitability, but the break-even point seemed to recede further with every new market entry. Analysts began to scrutinize the numbers, revealing a terrifying burn rate. This wasn't just spending, it was an inferno, consuming investor capital with frightening efficiency. The financial gravity was undeniable. The moment of truth arrived with the filing of WeWork's S-1 prospectus for its highly anticipated IPO. This mandatory public document, intended to woo investors, instead revealed a shocking tapestry of losses, bizarre financial structures, and unprecedented corporate governance issues. Investors saw past the glossy marketing to the stark reality: a company hemorrhaging money with no clear path to profitability, led by a CEO with deeply entrenched conflicts of interest. The prospectus became a siren call of caution, not a declaration of triumph.
The market reacted swiftly and brutally.
The emperor, it turned out, had no clothes, only debt. Beyond the financial losses, the S1 exposed a truly bewildering array of corporate governance red flags. Adam Neumann's self-dealing was rampant. He owned properties and leased them to WeWork. He took personal loans from the company, and, most infamously, trademarked the We brand and sold it back for millions.
His wife held significant influence over executive appointments.
These revelations painted a picture of a company where the founder's personal interests were inextricably, and controversially, intertwined with corporate assets. This level of conflict of interest was simply unacceptable for a public company, shattering investor confidence.
Trust, once broken, is impossible to mend.
The $47 billion valuation, once a symbol of Silicon Valley's boundless optimism, began a terrifying descent. What started as whispers of concern quickly escalated into a roar of doubt. Analysts slashed their price targets, and potential investors recoiled. The market's perception shifted dramatically, recognizing WeWork not as a tech titan but as a volatile real estate play, burdened by massive liabilities. The initial target IPO valuation of $47 billion plummeted, first to $20 billion, then to just $10 billion, and eventually, the IPO was pulled entirely.
The fall was dizzying. Each drop a heavy blow, echoing through financial markets worldwide.
The inevitable arrived. The planned initial public offering was indefinitely postponed. Without the fresh capital an IPO would bring, WeWork faced a liquidity crisis of epic proportions.
The company was on the brink.
The board, under immense pressure, acted decisively. Adam Neumann, the visionary founder whose charisma had built the empire, was stripped of his CEO title and eventually forced out of the company he created. He departed with a golden parachute worth hundreds of millions, leaving a trail of questions and a company in tatters. It was a swift, brutal end to a reign built on relentless expansion and a cult of personality. The dream crumbled, a stark, painful reality setting in. Facing imminent collapse, WeWork was thrown a lifeline by its largest investor, SoftBank. The Japanese conglomerate, led by the enigmatic Masayoshi Son, had already poured billions into WeWork. To prevent a complete write-off of its investment and to prop up its vision fund, SoftBank orchestrated a massive bailout package worth over $10 billion. This included a tender offer to buy out other investors, providing much-needed liquidity but at a devastating cost to SoftBank itself. It was a desperate gamble, a doubling down on a losing hand, driven by the fear of an even larger catastrophe. The bailout prevented immediate bankruptcy, but the wounds were deep, and the future uncertain. With Adam Neumann gone, WeWork began the arduous process of rebuilding under new leadership. The focus shifted from aggressive expansion to operational efficiency and, critically, profitability. Thousands of employees were laid off, non-core businesses divested, and lease agreements renegotiated. The dream of elevating the world's consciousness was replaced by the harsh reality of cutting costs and managing a massive real estate portfolio. The once celebrated amenities were scaled back, the free beer and kombucha no longer a priority. The company was forced to reckon with its true identity, a real estate company, albeit one with a tech-enabled platform. It was a brutal awakening. Just as WeWork attempted to stabilize, a new, unforeseen storm gathered, the COVID-19 pandemic. The global shift to remote work decimated demand for office spaces, flexible or otherwise. Cities emptied, and co-working environments, once lauded for their collaborative energy, became health hazards. WeWork's core business model, predicated on shared physical spaces, was fundamentally challenged. This existential crisis delivered a near-fatal blow, pushing an already struggling company deeper into distress. The very concept of shared office space, which WeWork had pioneered, was now its greatest vulnerability. It was a cruel twist of fate, an external shock accelerating an internal rot. Today, WeWork continues to exist, a shadow of its former self. Its footprint is significantly smaller, its ambitions tempered. The brand still occupies prime real estate in major cities, but the vibrant, community-driven narrative has largely faded.
Many of its once grand spaces sit partially empty, monuments to a bygone era of startup exuberance.
The company managed to emerge from bankruptcy protection in 2024, but not without substantial restructuring and massive losses to its creditors and investors. It is a leaner, more traditional real estate operation, stripped of its tech unicorn mystique.
The silence in its glass offices is a powerful, persistent reminder.
From the moody, overcast skies above Manhattan, the gleaming towers still pierce the clouds.
But look closer. Many of their windows are dark. Their once lively co-working floors now gather dust.
These empty structures, architectural triumphs of glass and steel, stand as a testament to the illusion that powered WeWork. They represent not just physical space, but the vast, gaping void left by a dream that collapsed under its own weight. The grand narrative of community, technology, and boundless growth unraveled, leaving behind the stark, unyielding reality of a real estate company with an unsustainable model. The emptiness is palpable, almost suffocating.
A silent, powerful statement. The financial fallout from WeWork's collapse rippled far beyond Adam Neumann. SoftBank, its primary backer, was forced to record billions in losses, impacting its ambitious vision fund and challenging Masayoshi Son's reputation as an astute investor. Numerous smaller investors, employees, and landlords also bore the brunt of the company's tumultuous trajectory.
The initial optimism of venture capital, the belief that WeWork could defy gravity, was replaced by a sobering realization of the market's unforgiving nature. This wasn't just a loss of profit, it was a profound erosion of capital, a destruction of wealth on a colossal scale. The numbers are staggering, the impact widespread. WeWork's dramatic implosion serves as a potent cautionary tale for the startup world and beyond. It highlights the dangers of unchecked founder control, the perils of prioritizing growth over profitability, and the seductive illusion of a tech label applied to a fundamentally traditional business. It forced a critical re-evaluation of venture capital practices, prompting greater scrutiny of governance, financials, and sustainable business models. The narrative shifted from disruptor at all costs to fundamentals first. The lessons are harsh, forged in the fires of immense financial loss. The market learned, the hard way, that hype, no matter how compelling, cannot sustain a house built on sand. Ironically, WeWork's original vision of flexible, community-centric workspaces has, in a way, been validated by the post-pandemic shift in work culture. Hybrid models and demand for adaptable office solutions are now mainstream. However, the future of work looks vastly different from Neumann's grandiose dreams. It is sober, pragmatic, and driven by efficiency rather than evangelical zeal. WeWork's legacy is complex, a pioneer that failed spectacularly, yet undeniably influenced how we think about the office. The empty spaces serve as a powerful reminder of how quickly even the most promising futures can dissipate when vision loses touch with reality. The echoes of ambition linger. The final count is sobering, $47 billion. A number so vast it's difficult to fully comprehend. It represents not just financial capital, but shattered dreams, lost opportunities, and a profound testament to the perils of unchecked corporate ambition. The gleaming glass towers, once symbols of innovation and progress, now stand as stark, silent monuments to a spectacular fall. As the overcast skies of New York's financial district loom, casting long shadows over the urban canyons, we are left with the chilling image of cash burning, endlessly, for a vision that ultimately consumed itself. The quiet, the emptiness, it truly speaks volumes. The market remembers. The consequences are real and immediate.